Hi everyone, very good afternoon to all of you present here. I'm Nitisha Jain, tax expert associated with Clear, and my area of expertise is income tax. Today, we all know as we all know, that we all have gathered to know about the investment declarations and what are the tax saving avenues. So, uh, my colleague Namita is also there to help you out in the chat box during the session. If you are having any doubts, any queries, you can post down in the chat box. Namita will answer all the questions over there. And once I'm done with the presentation part, I'll also be taking a few questions at the end. So, without any further delay, let's move towards our today's agenda. And before starting the session, I would like to thank you all for joining in such a great number. So, I'll try to make this session very interactive one, and I hope you all will have the valuable inputs with it. So, our first topic, which we all are going to discuss about, is new versus old tax regime. How we can decide that what will be the best option for ourselves, as per depending on our slab, depending on what income we are having, how much tax we are paying. Accordingly, we'll see that which regime will be useful for you, old or new regime. Then, what are the tax saving ideas to increase your take home salary and maximizing your ATC deductions? Then, what are the tax saving avenues? How we can, what are the tax saving avenues? Then, apart from that, we'll see the national pension scheme benefits. And apart from ATC, also, there are many other tax saving avenues. Apart from ATC, we'll be discussing that, followed up by Q&A session. So, coming on to our first topic, which is understanding the new tax regime for the financial year. So, as we all know, that some people are still having this doubt that which regime I have to choose, what will be the good option for me. So, for that, this is the second year in which you can opt between these schemes. From last year onwards, we all were having options to switch between the regimes. This was long demanded by most of the taxpayers, but it came with the catch of removal of all the deductions and exemptions that were available under the old tax regime. But last year we saw that many people are still not having the clarity about the new regime, when to use it, who all can opt for this, what will be its benefits, and all. So now we'll be discussing all of these topics over here. Budget for 2021 has introduced a new tax regime which an individual taxpayer can opt for, of lower tax rates coupled with very few deductions available and fewer exempt allowances available instead of the regular tax regime where you have to pay tax at higher rates, but you have right to claim various exemptions and deductions. Salaried people have right to choose between the old regime or new regime every year, but the person who are having business income cannot go back to the old regime once they have opted for new regime unless you discontinue your business. So, the person who are having business income has to make his choice between these two alternative tax regime, taking into account the long term tax implications. So, the new tax regime has lower income tax rates for income up to 15 lakhs. But what needs to be focused upon is that lower income tax rates lower income tax rates are available only if taxpayer is willing to give up all the exemptions and deductions which are available. Salaried individuals are granted an option to choose between the regimes at the time of making their tax declarations to your employer for the purpose of TDS. Even if any individual chooses okay, so yes, say for example, to continue with old tax regime for this particular year, and when you are filing your income tax return at the end of the year, then at that time you found out that you are getting more benefit under the new income tax regime. So at that time you want to switch to the new regime. If you are only the salaried individual, then also you can switch to new regime at the time of your return filing, even if you have submitted to your employer and that you will be continuing with the old tax regime. So this is the benefit which the salaried individual gets. But if the other individual who is having the business income has selected that he is continuing with the new regime this for this financial year, then from next year onwards he is not having any option to switch back to the old regime since he has selected for the new regime. Hi, there was some connection issue. Am I audible now? Can you please let me know? Hi, am I audible? Okay, thank you so much for letting me know. So, yes, resuming our topic about the new taxation regime, as I said, as we can look into this slab rate table, new regime versus old tax regime. So, income from 2.5 to 5 lakh is taxed at 5%. Then, uh, income between 5 lakh and 7.5 lakh would be taxed at 10%, while income between 7.5 to 10 lakh would be taxed at 15%. This was 20% flat on the entire range for the existing regime. Earlier rupees 10 lakh plus slab rate, where you paid 30%, has now been broken into three parts, with rates of 20% for 10 to 12.5 lakh, 25% for 12.5 to 15 lakh, and then 30% for 15 lakh and above. The current tax system is complicated to say the least. So, while the tax rates are high, there are a lot of ways to reduce your tax liability. Now, there are some common questions. First one, which regime is beneficial for me? Unfortunately, there is no single answer to this. Although, looking at the reduction in the tax rates, the first reaction which would come into everybody mind would be that new regimes are having lower tax rates, so that would be better. This should not be your criteria for selecting that, because someone who is having 7.5 lakh income will have to pay 25,000, and for those who are earning 10 lakh income, tax saving will be 37,500. For these savings, you'll have to let go all of the exemptions and deductions which might nullify these gains. While figuring it out whether to choose the old or new tax regime, this might look complicated, but if you approach it in a systematic way, it is not that difficult to figure it out. Here is what you need to do. First of all, you'll have to calculate all of the exemptions that you are availing. If you are living on rent, you would be claiming HRA, right? Which is the biggest salary exemption which anyone enjoys. Apart from that, other tax free components include LTA, food bill, phone bills, etc. So, all these will become taxable if you choose to shift to the new tax regime. Second point, you have to look at all of the deductions that you can claim. So as a salaried employee, two deductions that you automatically get are standard deduction of 50,000 rupees and your contribution towards your employee provident fund. In the new regime, you won't be able to claim these deductions even though you will continue to contribute to EPF. Over and above, you cannot even claim deductions against your own home loan if you have any one or insurance policy, which still now has helped to reduce a taxable income to great extent. Now combine all of these exemptions and deductions and minus them from your salary to see what is your taxable income and what it would be if you let go all of these deductions. So this should be a deciding factor for which regime you should go with. When all the data you had gathered of your investments and all, then you can just use this clear tax calculator link, which will help you to identify which tax regime will be more beneficial to you, and you can take your decisions accordingly. Namita will provide this link in the chat box of the calculator. So using this calculator, when you will click on this link, you will be redirected to this kind of page. In this, first you will have to select what age group you are of. Then in the second point, it will ask you about your income details. So if you are having any income from salary, you have to enter that. Then in interest income, you'll have to enter. If you are having any kind of house property income, that you'll have to enter. Then in this third point, you'll have to enter the deductions part. Whatever deductions you are claiming, whether it is from ATC, ATD, all of these deductions you can enter. Then in fourth point, you will get a summary table in front of your screen of the old regime and the new regime. That in that table, you will see that which regime is beneficial for you, what amount of tax you are getting in the old regime, and what amount of tax you are getting under the new income tax regime. So this calculator will help you to understand very clearly that what regime you should go with in the next upcoming year also. So this was about the new regime. Now I'll explain this via one example also. Say for example, Miss Y is an employee who earns rupees 8 lakh a year. Being salaried, she contribute towards EPF and also she is getting HRA benefit because she is living on rent. So apart from this, she gets LTA because she incurred 25,000 on traveling, and she is not able to save anything apart from EPF. Now let's see which tax regime is beneficial for her. As we can see, her annual income was 8 lakh rupees. We entered both the under the regimes. Then under the old tax regime, she'll get standard deduction of 50,000 rupees, EPF contribution 25,000, HRA 30K, leave travel allowance 25K, and her net income, which is coming under the old regime, is 6 lakh 70,000, and in the new regime it is 8 lakh, because these all deductions are not available under the new tax regime. Then this was the tax slab rates. Now, as we can see, she is getting more tax under the old taxation regime and less under the new income tax regime. So, as we can see, there is more tax saving by opting for the new regime instead of old, with tax burden going down by 1,560 rupees. So, sometimes old regime may be beneficial for you, sometimes new regime may be beneficial for you, So it will all be depending upon what all deductions you are claiming, what all incomes you are having. Accordingly, you can make the choice very wisely. Now, coming on to our next topic about what are the smart tax saving investments to increase your take home salary. So, as we all know, first and foremost deduction which everyone enjoys is the house rent allowance. It means the component of salary which is received towards the rent payment and is allowed as deduction from taxable salary. HRA exemption is allowed. It is having three conditions. So, whatever will be the least amount from all of that three conditions will be allowed as HRA exemption. Some people are having this doubt that whatever amount of rent I am paying, that entire amount I can claim it as HRA. This is not the right thing. First condition will be actual HRA which is received by the employee. Second, 40% of the salary for non-metro city or 50% of the salary if you are rented property situated in metro cities like Mumbai, Delhi, Kolkata and Chennai. And third condition will be actual rent paid less 10% of your salary. So whatever will be the amount from these three conditions, least amount will be allowed as your HRA exemption. Many people have this question that what if I'm having a home loan as well as I'm paying rent also? So can I still claim HRA? Answer to this question is yes. Benefit of HRA can also be claimed if you own a house and are claiming deduction of house property, as well as you are if you are living on rent, then you can claim HRA also. But there is one again one another point under this HRA thing is that due to this COVID situation since last 2 years, we all were living with our parents. Most of us were living with our parents. So now, are you also unsure about how to claim HRA if you were living with your parents? Those who live with their parents can pay rent to them and save tax on HRA. Now, how to claim HRA by paying rent to your parents? First of all, for that, you can pay rent to them. They should be done by transferring money rent to their bank, or you this way you can save claim the HRA deduction very properly. Since rent is paid to the owners, property must be owned by your parents only. It may be owned by one or both of your parent. So you can deposit the money to any one of the parent. In case of joint house ownership, or the parent who is the legal owner of the house, remember that you cannot be the owner or co-owner of the property, since you cannot claim tax exemption on rent paid to yourself only. There will be some documents all which will be required to claim HRA. First of all, you can submit. Usually, employers ask for the rental receipts or rental agreement, so you can enter into rental agreement with your parents, and after that, you can submit those receipts or rental agreement to your employer. Now, whatever rent you have paid to your parents, that rent paid will be taxable for them. Rental income paid by you is to be reported under the head income from house property in your parents' income tax return. However, they can also claim property taxes which are paid by them and also claim 30% of standard deduction from their rental income. Now, if you have forgotten to submit your rental receipts to your employer early, then also there is no problem. At the time of return filing, you can just use the HRA calculator, which will be provided on Google. There is ClearTax HRA calculator. You have to just provide the basic information, and after that, they'll that calculator will help you to correctly calculate that what is your exact HRA exemption amount. That HRA exemption amount you can directly include in your income tax return filing. So this is the main thing about HRA. Now, secondly, the interest paid on home loan. So everyone wants that we should have our own house one day if we are staying on rent. So for that purpose, government has also provided various kind of taxation benefits. Home loan, now what are those benefits and everything? We are going to discuss about that. Home loan must be taken for purchase or construction of house, and the construction of the house must be completed within 5 years from the end of financial year in which the loan was taken. If you are paying EMI for the housing loan, it will have two components. First one will be the interest payment, and second one will be the interest principal repayment. Interest portion of the EMI would be covered under Section 24 and you can claim maximum up to rupees 2 lakh under section 24 in the head of income from house property. And the another component, which is principal repayment, that will be covered under ATC deduction up to the maximum limit of 1,50,000 rupees. If you are also having any kind of stamp duty, registration charges, these all you can claim under ATC section only in the year in which you have incurred those expenditure. Now there is also deduction in respect of the interest paid towards home loan during the pre-construction period. Say, for example, you bought an under construction property and you have not moved in yet, but you are paying the EMIs. In this case, your eligibility to claim interest on the home loan as a deduction begins only upon the completion of construction or immediately if you buy a fully constructed property. So, does this mean you would not enjoy any kind of tax benefits on the interest paid during the period falling between borrowing of loan and the completion of construction? No. Let's understand this why. The income tax law here provides for the claim of such interest also, which is called as the pre-construction interest period, as a deduction of 5 equal installments starting from the year in which the property is acquired or the construction is completed. Over and above the deduction, you are otherwise eligible to claim from your house property. Maximum eligibility will remain capped up to 2 lakh rupees only. Then, after that, all the deductions of Chapter 6A are going to start. So, under this first and foremost section, which most of the people avails or invest money into, is ATC deduction. Income tax department, with view to encourage savings and investments among the taxpayers, have provided various deductions from the taxable income under this chapter 6A. ATC is one of the most popular and favorite section, I can say, amongst the taxpayers, as it allows to reduce taxable income by making the tax saving deductions which are beneficial for the taxpayers to reduce their tax liability. Now let us understand all of these reductions in detail. It is important to note that the overall limit of ATC deduction will be capped up to 1.5 lakh rupees only. First deduction which comes into, so under this ATC deduction, first one is EPF. Employer gets reduction for the amount contributed towards EPF of the employee as business expenditure. There is no tax liability for the employee in respect of contribution which is made by the employer up to 12% of the basic salary, beyond it which becomes taxable in the hands of employee. Likewise, in case of aggregate amount of contributions made by employer towards employees EPF, superannuation or NPS account of the employee taken together, if it exceeds 7.5 lakh, then such excess amount becomes taxable in the hands of employee. Then second deduction which comes into picture under ATC is about the children's tuition fees. So the tuition fees which is paid for the education of two children is eligible for tax reduction under ATC up to 1.5 lakh limit. This fee can be paid to any kind of college, university or educational institution situated in India. Fees have to be for full-time courses only. So under then, if you are having, if you have taken any kind of life insurance premium, so the annual premium which is paid, the annual premium paid for life insurance in the name of taxpayer or taxpayer's wife and children is an eligible tax saving or payment under ATC section. Deduction is valid only if the premium is um, so, apart from life insurance, as I said in the previous slides, repayment of principal loan is also coming under in this principle of deduction, as we discussed in the previous slides, that principal house loan will have two components: interest one and the principal repayment. Interest deduction will be forming part of income from house property head, and the principal repayment will be coming under ATC deduction limit. Apart from this, if you are having any kind of ELSS mutual fund also, well, and again it is getting lost. अभी मैं लाइव दिख रही हूँ क्या? Okay, okay. Um, Hi. I think it is some issue in the network only. Sorry for the inconvenience caused. So, if you, yeah, apart from all of these deductions which we have talked about, if you are also having ELSS mutual fund, you can invest in ELSS the same way that you invest in any kind of mutual fund. Easiest way is through the online investment service account. You can invest either as lump sum or via the SIP route. SIP ensures the regularity and discipline and reduce the risk to capital. You can invest as little as rupees 500 in an ELSS fund. While you can claim the tax benefit only up to 1.5 lakh rupees, you are free to invest as much as you like. With the lowest lock in period of 3 years and the better return, they are also very tax efficient. Apart from that, AT section, which talks about the deduction for payment towards annuity pension plans, pension received from the annuity or amount received upon the surrender of annuity, including the interest or bonus accrued on annuity, will be taxable in the year of receipt. Then now, if you yourself are contributing towards NPS, then and in that section, ATCCD 1B comes into picture. In that section, now let's talk more about NPS. So, if you're concerned about your retirement and are looking forward to plan with tax saving benefits, then NPS is the best tax saving instrument. NPS is known for its investor friendly features, low cost structure, and flexibility. Here, you can invest as minimum amount of 6,000 rupees in installment or at least rupees 500 as lump sum. Being the investor, you get to decide how to allocate money for investments or any kind of corporate bonds and equity. Under this section 80CCD1B, you can claim additional self contribution up to rupees 50,000 as the NPS benefit. This scheme therefore allows tax deduction up to rupees 2 lakh in total. As a pension scheme, it is important for you to continue investing until the age of 60. But if you have been investing for at least 3 years, you may withdraw up to 25% for certain purpose, which may include the children's wedding or their higher studies or building or buying home a house, medical treatment, anything it can be. You can make withdrawal up to 3 times with a gap of 5 years in the entire tenure. Now there are two primary accounts of NPS, with this tier 1 account and tier 2 account. Status of tier 1 account is default and it is mandatory. So tier 2 account is voluntary. Withdrawal is not permitted under tier 1 account, but in tier 2 account it is permitted. The tax exemption which you are going to get under tier 1 account will be maximum up to 2 lakh rupees if you combine two sections, which is ATC and ATCCD 1B. ATC is having the maximum limit of 1.5 lakh plus ATCCD 1B, which is having maximum limit of 50,000. So altogether, you can claim rupees 2 lakh deduction under tier 1 account, and under tier 2 account, it will be 1.5 lakh for government employees, and for other employees, it is none. Minimum NPS contribution, which can be in tier 1 account, would be 1000 rupees per annum, and tier 2 it will be rupees 250. There is no maximum NPS contribution limit under both the accounts, whether it would be tier 1 account or whether it would be tier 2 account. You can contribute as many amount which you want under both the accounts. So if you want your employer to contribute on your behalf, suppose you have already exhausted the entire limit of 1.5 lakh and you yourself has also contributed under NPS in 80cc 1b section, and you have claimed additional 50,000 rupees over and above the limit of 1.5 lakh, still you want to invest some more amount, then in that case you can ask your employer to contribute in NPS. So under that case, in that situation, 80ccd2 section will come into picture. Under this section, you can claim maximum up to 10% of the salary. The good part under this section is that there is no monetary ceiling limit. It will be depending on your salary. So as per your salary, maximum you are allowed to get 10% of the deduction. Now there are some other deduction also apart from 80C. What are those? We'll be discussing one by one. So, talking about the 80D section, 80D talks about if you are having any kind of medical insurance premium for for yourself, your spouse, and your children, then you are allowed to claim maximum deduction of 25,000 rupees if your age is below 60 years. But if you are senior citizen, then this amount will get increased to 50,000 rupees. But if you have also taken medical insurance premium for your senior citizens parent whose age are above 60 year, then in that case you are allowed to get maximum deduction of 50,000 rupees. But say for example you don't have any kind of medical premium for your senior citizen parents, but you are incurring medical expenditure on their behalf, then also remember this, that for your uninsured parents, you are allowed to claim medical expenditure deduction up to rupees 50,000 under this 80D section itself. But that deduction is only available for senior citizen parents who are not having any medical insurance premium. Then only you can claim the medical expenditure bill. Then if you have any kind of if you have incurred any kind of medical treatment for the handicap dependent, then 80DD section comes into picture is available to resident individual. Then expenditure incurred on medical treatment, including nursing, payment or deposit uh, to specified scheme for maintenance of handicap dependent relative. So under this case, where disability is 40% or more but less than 80%, then you are going to get flat deduction of 75,000 rupees. But where there is severe disability, which means disability is 80% or more, then you are going to get flat deduction of 1,25,000 rupees. To claim this deduction, certificate of disability is required from the prescribed medical authority. Then, under 80DDB section, which is medical expenditure on yourself or dependent for disease which are specified under this section. So, for the individuals whose age is below 60 years, deduction up to 40,000 rupees is available to resident individual. It is available with respect to any expense incurred towards treatment of specified medical disease or ailments for himself or any of his dependents. For HF also such deduction is available. Now, for senior citizen parents and super senior citizens, I can say, in that case, the individual on behalf of whom such expenses are incurred is a senior citizen. The individual can claim deduction up to 1 lakh rupees or the actual amount which he has paid. Whatever will be the lower amount, that will be allowed as deduction under 80DDB section. Then, if you yourself are suffering from any kind of physical disability, then 80U come into picture. Deduction of flat 75,000 is available to the individual who suffers from physical disability, including blindness or mental retardation. In case of severe disability, one can claim deduction of 1,25,000. Now, if you are having any kind of educational loan, it helps you not only to finance your foreign studies, but it can save you a lot of taxes as well. If you have taken an educational loan and you are repaying the same, then the interest paid on that loan is allowed as deduction from the total income under Section 80E. However, the deduction is provided only for the interest part of the EMI. There is no tax benefit for the principal part of the EMI. Yes, I repeat that whenever you take the loan, you get a certificate from bank, right? In which interest portion is also mentioned and the principal part is also mentioned. So under the educational loan case, you are going to get deduction of only the interest part of the EMI and not for the principal part of the EMI. But the good thing about this section is that there is no maximum limit of which you can claim the deduction. Whatever interest amount you are paying, entire amount you can claim it as deduction at 80E section. It is available only for 8 years, starting from the year in which you start repaying the loan or until the interest is fully repaid, whichever is earlier. It should also be noted that if your loan tenure exceeds 8 years, then you cannot claim deduction for the interest paid beyond 8 years. So it is always advisable that educational loan should be paid within 8 years period. Then, if now government is promoting electric vehicles, right? So under that situation, if you have also purchased electric vehicle, then you can claim deduction, and for that 80EB comes into picture. In this situation, reduction is available only to the individuals. Deduction for the interest payments up to rupees 1,50,000 is available under 80EEB. An individual taxpayer may have electric vehicle uh, for personal use or for business use. This deduction would facilitate individuals having an electric vehicle for personal use to claim interest paid on the vehicle loan. In case of business use, an individual can also claim the reduction up to 1,50,000 under Section 80 EEB. Any interest payment above 1.5 lakh can be claimed as business expense. To claim as business expense, it is necessary that the vehicle should be registered in the name of the owner or the business enterprise. So, do note that individual taxpayers should obtain the interest paid certificate and keep all the necessary documents such as tax invoice and loan documents handy at the time of filing of the ITR. So these were all the deductions. And also, if you have donated some amount to the charitable organization, to the registered charitable organization, then 80G comes into picture. There is long list of the donation list. Some are eligible for 50% exemption and some are eligible for 100% exemption. That list you will be able to get easily on the Google site. Namita will provide the link in the chat box of 80G section. So ATG talks about the donation. Some will be eligible for 50% and some are eligible for 100% deduction. Now, if you are also having the saving bank interest income, if you are having that income, first of all, you'll have to include under income from other sources. And once you have done that, if your interest income is up to rupees 10,000, then in that situation, you are going to get deduction up to rupees 10,000 under 80TTA section. So these were all about the tax saving avenues, how you can maximize your taxes, how you can help in reducing the tax liability to great extent. Now I'll be happy to take a few questions. Among us is having one question that I have owned flat in Delhi and my parents staying in Delhi, but my job is in Bangalore and staying in Bangalore on rent. So, yes, if you are having your house in Delhi, but you are living in Bangalore and paying the rent over there, then you can claim the HRA benefit over there. Who are sending these abusive chat messages? I request you to stop, please. This is the professional platform. Um, Sujay Kumar, NSC, National Savings Certificate option, if you are having, then this is also allowed as ATC deduction, and you can claim it over ATC. In that ATC limit, it will be included, which is 1.5 lakh rupees. Harsha, as I said, that you can use that clear tax calculator, and in that you can enter your salary income, whatever deductions you are claiming, you can enter that, and in the summary table you will get to know that which regime is useful for you. Vivek, no, there is no maximum limit. Shubham, yes, whatever for whatever months you are paying the rent, for all those months only you will be allowed to claim the HRA amount. As simple as that. Vijay Kumar, paying rent to parent with respect to tax proof does require to submit rent receipt in case. Yes, if you have also paid rent by cash, then also you'll have to submit the rental receipts to your employer, and then only you will be allowed to claim the HRA benefit. Someone has asked if I opt for the company accommodation. They'll charge me nominal rent, but they add a perk in accordance with tax law. So whatever perquisite it was, you have to ask this to your employer itself, that is it allowed in the deduction portion. If it is allowed, if they said yes, if they say yes, then you can claim it in your income tax return. See, among us, if you are having the house property in Delhi itself, where you are paying rent, if you are having the home loan for the Delhi property, and also you are living on rent in that same city, then you are not allowed to claim HRA benefit. Abhilash, yes, for that section 54, you have to read in detail that under that section you can claim. Pranita, then your employer will help you in this case, or you can yourself use the HRA calculator to know that what is the HRA correct exemption amount which you are eligible for getting. Rent receipt is also acceptable, or if you submit the rental agreement, that is also acceptable. Whatever you are comfortable with, you can submit that document. Flexible benefit allowances are different. Like, actually it varies from company to company. So when this you have to ask your employer only. There are many flexible benefit allowances that you can claim in your ITR. Now it depends on your company that what they are allowing. Abhilash, I've already answered this your question. Roshni, yes, if it exceeds the particular amount. AKS, you can pay rent to your mother if your mother is also the house owner of that property. If your father is only the sole legal owner, then I'll have to pay rent to them for claiming the HRA purpose, I'm saying. If you have not declared any kind of investment to your employer, so at the time of your return filing also you can claim, but provided that you are including that amount only which is actual. You cannot just enter the fake amount. So if you have actually made the investment, then only you can enter it in your ITR. This was answer to John's question. Vijay, yes, as I said, okay, many people are having this doubt about the HRA thing. So I'll repeat that portion again. If you are having the house property on which you have taken the home loan, okay. Say for example, you are having a home loan for the property which you have taken in Delhi, and in Delhi only you are living on rent in another property. In that situation, you cannot take the HRA benefit of that Delhi property. But say for example, you are having the house loan for the property which is situated in Delhi, but you are living in Bangalore on rent since your company is located over there. Then in that this situation, you can claim the HRA benefit for the Bangalore property which you are living on rent, and also you can claim the home loan benefit for the property which is situated in Delhi. I hope now. Sheil, yes, you can. Um, yes, if it exceeds 1 lakh rupees total for a year, then you'll have to show the PAN card. Akash, it depends that if you have already exhausted the entire limit of ATC under which PPF, EPF, and ELSS mutual fund are included. NPS is different section, but in ATC, PPF, ELSS, and EPF are covered. So if you have taken those benefit, then well and good. Then you can switch to NPS because it is very uh, it is that investment which is useful for long term your implication. For retirement purpose it is very good option. So if you are asking for as of now investment, then you can go with ELSS or PPF. Bindu, if you are buying any property by couple, so in that case joint house property you'll be having. So under that situation, whatever percentage you both are having, accordingly you have to split the interest amount in your both the income tax returns. If you have any further questions after this session also, you can write to us at support@cleartax.in. Our support team is there who can help you out with all the questions over there. I'll be providing this mail ID in the chat box. You can write to us at over there. So, someone has asked me about the Atal Pension Yojana. Atal Pension Yojana account, if you are having that, then also you can enjoy the tax benefit, including the additional deduction of 50,000. Due to lack of time, we'll have to wind up the session. You can write to us at support@leatas.in to our mail ID. Uh, there we'll be happy to answer your remaining questions. I hope you had this valuable session. This was useful for all of you guys. Have a great day. Thank you so much, everyone, for joining.